folks, we will be having our panel. And so I'm going to have each of our panelists briefly introduce themselves. And so we'll be starting off with, who shall we start off with? Let's see. We shall start off with Richard Ball, Director and Certified Petroleum Geologist with Detroit Energy Advisors.
Hi, thanks, Mark. Appreciate it. This is Richard Ball, as Mark mentioned. I'm not a Mark, I'm Richard. That's fine, I guess. So really happy to be with everybody tonight and join this distinguished panel. My career started really in Lafayette, where I was a geotech. So I'm a geologist by the earliest part of my career. Went to school at Stephen F. Austin and University of Louisiana Lafayette, and then joined Chevron out of school. Had a 10-year career there working in the San Juan Basin, onshore U.S., Deepwater Gulf of Mexico, and international water floods in Angola. But was really drawn to more of the business side of things. So joined Detroit Energy Advisors in 2016, the end of 2016. I've been there about 5 years now, a little over 5 years at this point. So I lead the geology and subsurface team for the group, and we focus on the middle market and the small cap market, which is between roughly, call it $2 to $20 million for the small cap, and then $20 million to $200 million some transaction size for that mid cap market. And so that's what our firm really focuses on, acquisitions and divestitures, primarily on the sell side, although occasionally we do buy side work. So really that's our bread and butter. And we have an interesting purview on the market, and I'll try to share some of that with you guys later today. Thank you, Mark.
Thank you very much. All these marks on the call are actually confusing. So,
thank you, Mark.
No worries. Thanks, Richard. All right, and so next, Josh Sherman, who is a partner at Opportune LLP.
Josh, you are muted. You'll need to unmute yourself.
Thank you.
Happens to all of us. Don't worry about it.
Yeah. Sorry. Thank you. So again, Josh Sherman with Opportune, as Mark mentioned. I'm partnered with Opportune, based here in Houston. My background is an auditor coming out of the University of Texas with the accounting degree, auditor for Deloitte, focused on both energy trading and energy firms throughout the full energy spectrum. From there, I've kind of moved on to a consulting business for the last 20 plus years, where advising companies and dealing with auditors, the SEC, et cetera, on public transactions, financings, and new accounting pronouncements.
Okay, fantastic. And then next, let's get Marc Jones. And
I'm Marc Jones. Work with Baker Hostetler, a law firm that's located. We have 18 offices across the United States. I've been primarily in the energy space, doing acquisitions and capital markets transactions. Over the years, I've represented a lot of management teams that are seeking private equity, and I've done a bunch of different commercial startups. I worked heavily in the life sciences area, healthcare, and biotech. I was general counsel for Argonne National Laboratories in Chicago. We had a lot of energy transition technologies, much of which are still available to be licensed, and they're still way early stage developments. And so I can help companies and management teams find capital if they need it.
Did you say you can help find capital, Mark?
I can help. I can introduction.
I think your inbox might be blowing up, sir. But anyways, and last but definitely not least, Deborah, we've had a couple of these together, and I really appreciate you and EY for joining us on this call. Deborah Byers, thank you.
Sure, I'm thrilled to be here, and what a fascinating opening, and I'm really excited to learn more about Greentown Labs and really the startups. A lot of information that resonated, so I feel a little inadequate here. I'm also on the advisory consulting side, a longtime partner at EY, 30 plus years in the energy sector, and like Marc Jones and Josh, spent a lot of time, working on the M&A side for many years. And then the last 4 years, I've led our America's strategy around all the sectors. And then I'm going to finish things up here around energy transition. So I'm looking forward to this discussion. And what a time to be an energy professional. I think you guys are going to be very, very surprised at the demand that the world and the economy is going to have on people that really understand the energy system. So excited for the conversation.
Great. Excellent. Fantastic. Superb. And so, yeah, we'll dive right in and we'll go directly to Deborah. So, Deborah, can you please speak to the trends in the investment for ESG with a focus on E and what that means for energy companies and how to leverage digital technologies to properly measure and report emissions, ESG targets, and if you have some of those stats on the money flows, kindly share those with us, please.
So there's so much money, but I think as the last speaker from Unique talked about, there's a lot of noise in the system. But I mean, if you just kind of back up, we've had a lot of discussions, a lot of capital noise around ESG investment, and it's starting to come into focus. I was really taken by the tone of Larry Fink's annual letter. As you know, he's been a very strong proponent of ESG investing. And, you know, for a while, people were concerned that he was kind of anti-energy, but he's really come out strongly. And if you read his letter this year, I ought to just read this one paragraph, because it really did strike me as something that, one, there was 11 paragraphs dedicated in his letter to energy transition, very specifically. But even more important, what he said in the letter around capitalism and sustainability, that, you know, from shareholders to employees to customers to communities and regulators now expect companies to play a role in decarbonizing the global economy. Few things will impact capital allocation decisions, thereby the long-term value of your company, more than how effectively you navigate the energy transition. When you have the CEO of a $10 trillion fund making those kinds of comments, it tends to garner a lot of attention. And, you know, there's been some crazy numbers throwing out there. You know, is it $100 trillion? Is it 90 trillion that's going to be deployed over the next 3 decades to chase energy transition? But just take it down to a much even smaller level. The recently passed Infrastructure and Jobs Act hasn't got a lot of attention because everybody's been focused on getting Build Back Better done. But there was $550 billion, and there's $70 billion just chasing climate resiliency. So think about some of the startups that were here around geothermal and being used for offsets, clean energy technology. That's the kind of sort of pre-startup, kind of very, very nascent technology that our own federal government, whether it's DOT or DOE, is looking to fund. So you don't have to go after these mega funds. Those are going to come, but they're going to be looking for, they need to be a little bit further down the development trail, more brownfield, pre-scale. You're going to see a lot of funding. I do think that there is room for more, real seed funding, and I'm just really shocked at the low level of that kind of investing and happening in Texas. And I think that's what we got to accelerate. Really get that discussion, and maybe even increase the noise about this is the market where you're going to solve these types of issues and create and have some real creative solutions. So tons of capital out there, but it's really matching that up with the different investment thesis, whether it's you're coming up with offsets. These technology companies are major energy hogs. They are going to have to come up with offsets. There isn't enough, green energy, swap agreements where they're going to be able to offset. They're going to have to get more creative and actually invest in these types of technologies to be an offsetter. So if you look at the thesis on breakthrough energy, which is Bill Gates' venture, that's his thesis. There's 4 technologies. You're going to have companies come in and be off-takers as well as funders of that technology. So it's wide open. The second thing I will say, in talking to even our own leadership team, but certainly going around talking outside the energy sector, the gap of understanding and knowledge of the complexity, the size, the scale, and really what is embedded in energy is incredibly big, the gap of knowledge. So I think it's incumbent on people in this group to get out there and send the message. You're not saying, hey, we want to keep fossil fuels forever, but what you're saying is it's going to take time, it's going to take capital, and there's some real incumbent energy technologies that really we ought to be leveraging. It's not all, new fancy batteries, that unknown technology that the IEA says isn't here yet that needs to come. There's some great stuff here, whether it's geothermal, whether it's energy efficiency. Just imagine a vehicle that is much lighter than it is today, an ICE vehicle, you're going to get better efficiency. So get out there and tell your story. I think it's an incredible time to be out there and really trying to get some of this capital, because there's a lot of it chasing, good projects.
Excellent, fantastic. That was a very in-depth answer. Thank you, Deborah. So we'll call you Mr. Jones. So, Mr. Jones, what have been the trends in private equity in 2022?
Well, like Deborah said, there's a lot of money chasing deals. ESG is of critical importance across sectors, and unfortunately, there's less and less for the upstream E&P. I have quite a few management teams that are looking for capital, and they're hoping the capital markets open up a little bit. We're seeing a little bit of that, but it's not. A lot more money's out there than they're struggling a little bit to find the capital that they need in the E&P sector. There's a lot of public offerings going on, and I think it's going to continue. And the fundraising activity is robust, and they're continuing to raise funds, and so I think it's going to be a robust environment for 2022.
Excellent, thank you. Josh, how has private equity investment and distribution strategies evolve post-downturn, and how does that affect geoscientists and geologists?
Yeah, so I think, we've talked about energy over, I guess, the last run up, and even through a couple of downturns. It's been a land game across all sectors. I mean, upstream, midstream, it's catching the hot basin. Maybe it's Permian, and it's created a lot of overinvestment trying to chase more like a land style, a real estate flip type mentality. Now, I think folks have to build a real business, right? That will be around for a while. And so you're seeing PE go to a invest and hold strategy, and how to return cash to their investors, right, and also receive cash themselves while they're holding. So grabbing tiger by the tail and hoping for a quick flip, either through the public markets, which we saw a lot of, it's generating cash flow. We're seeing less allocation to just to straight private equity, or to say from private equity to specific types of investments, whether it be upstream, Permian, or midstream, or what have you, to looking for real cash flow opportunities across the sector, and that could be technology that's involved in any of these sectors, or it could be even some businesses that have been less in favor of coming back around oilfield service. So I think in general, and PE is stepping back and looking for, again, cash type investments, something that's going to generate cash flow in a near term that they can hold on to for a while. And for that, as far as you mentioned, geologists and geoscientists, I think even as less capital may be going underground, and people are looking for that capital and less of it, I think it creates more opportunities for geoscientists, people who are specialized in looking for those real opportunities. And then it's not just upstream. It's, we talk about geothermal, carbon capture, sequestration, and storage. That's we're actually looking at real assets, and I think their knowledge and their experience across a number of basins is going to be very impactful in this term, versus let's call it the land folks that know how to, not to generalize, pick up the phone and generate, whether it be capital or kind of capture some deals.
Excellent answer, Josh. Richard, Josh did mention digital. Can you explain how digital transformation will lead the way in unlocking efficiencies, cutting costs, and enabling new business models?
Yeah, sure. I think that I think back to my time at Chevron and working on some of the fields that were historic, that were legacy assets acquired by the company then, and how Chevron was applying technology for really, it's kind of been one of the things they've focused on in the forefront for some time. And just looking at the landscape now, thinking about operators, groups that are out there, aggregation of data has changed everything in my view. We're able to now, as a small company with 4 geoscientists on staff, tear through a basin in a record amount of time. It's absolutely stunning, where that would have taken months, if not years in the past. So everything from really data aggregation to being able to process that data, all the way to what you've seen as far as offshore evolving over the last 30 years, really, to seismic processing. Everything you look at from the oil and gas standpoint has really gone from analog to digital, and that's driving an incredible amount of change throughout our entire oil and gas world. And that's, of course, not just limited to oil and gas. That's all sectors. Everybody here on the panel has some understanding of the different aspects of alternative energies, but the same things are being applied there, just probably more from a ground zero aspect than the past 900 years, essentially. So we're seeing that transition occur. It's driven by big data for the most part, but there's no slowing it down now, and it's going to get more integrated as we go forward, I think.
Super. And then same question to Amy, if you can chime in on that briefly, and then also Deborah as well. And just if I repeat the question, can you explain how digital transformation will lead the way into unlocking efficiencies, cutting costs, and enabling new business models?
Well, I mean, for right now, I mean, that's your low-hanging fruit, right? For existing. I mean, it reduces it's your decarbonation path. It reduces your foot traffic. I mean, it's got a ripple effect. If I don't have to have as much people out there on the field, I can reduce my insurance out there. I can have optimization that I couldn't normally do just because of computing power. You've got a lot of companies that have been thinking that they're running a lot of data, like through their SCADA systems. We've had some pilots over at midstream companies, and they found out that they're only utilizing 10% of that data, right? But with some of the more advanced, analytics with your machine learning, the ones that actually truly have machine learning, now they're being able to do more optimized analysis, and in terms when it comes to maintenance. It gets into your planned and unplanned shutdowns. It's your whole OE metrics, right? And so people have to remember that the E in ESG is really on your asset operational excellence at the end of the day, right?
Thank you kindly, Amy and Deborah.
Yeah, I think, look, it's finally kind of happening, this whole digital revolution that needed to really hit this sector. Richard, you talked about being able to do what, minutes and probably multiple scenarios as well. I mean, we worked on well design where you can compress, 3 months to a couple of weeks, and you can do optimization on tight curves, you name it, right? All sorts of design parameters, and you can run multiple optimization programs, which might have taken, you can only do 2 because, hey, you're on a timeline. Now you can do like 10,000, right? And still meet that same timeline. And part of that, this is something that I think a lot of people haven't really digested outside of the sector is, it's the rise of cloud computing. So Amy talked about computation power. So you had a lot of data, but in order to crunch that data, you need a pretty significant amount of computational power, and not every company could afford that. I mean, if you were one of the big IOCs, you could go out and, have that kind of computation power on premises. Now you can do that on the cloud, right? And on your phone. So this is the kind of innovation that has unlocked for smaller companies, startup companies, to be able to come to the table and do very sophisticated analysis and modeling. And that's all with the cloud. So that's why you see an Amazon or Microsoft, Google, they're all in energy services, because think about the data that's got to get crunched and the volume of data. So that's one sort of just, unlimited optimization efficiencies, whether it's digital twin on predictive maintenance or, demand management around energy intensity in your operations. Secondly, what is going to come and hit us really hard is going to be the data need. So what's the number one thing on ESG? The E is moving large. So you got the SEC moving, Josh, as you know, expecting guidance around climate disclosures. That's going to require data. So I call this making emissions visible. In order to make emissions visible, since they are greenhouse gas emissions are invisible, you're going to need to gather a lot of data. You're going to need to crunch a lot of data to associate that directly with your operations and prove whatever commitments have been made by management. But this data need is also going to be a massive draw on anybody that can come to the table with the kind of real-time data, digital tools that can provide that measurement and ability. So anyway, it's just really wide open. And I think the onset of cloud, and you think about now computing at the edge, so you've got devices that can do small micro computations right at the sensor level, send up the big energy intensive computations at the cloud. It's really wide open. And it's not just limited to big companies that can have, massive amount of computers on premises.
I just want to add one more comment, Mark, if that's possible, because I thought Deborah had a lot of good points. So what this is going to mean to companies, and this is part of the dialogue we're having with them, is your commodity really is going to be your data. So companies are going to have to understand and place a value on this data at the end of the day and decide which pieces or components are important for them. Companies like, USAA and financial conglomerates are already trying to do this at the end of the day. So there's a lot of, it's like when the ERP systems came into the energy industry, right? You're really going to have to relook at what are the key pieces of information do I need to that really drive my decision-making process at the end of the day, all the way from the operational level, all the way to the board level. It's not as easy as just, okay, I've got the computational, I've got the cloud, I can do all these computations, right? There is that whole internal risk and decision-making process that has to be addressed, right? And that's real heavy lifting. That's really heavy, we're going to have to do.
Excellent, super. And there's a question in the chat, a question to the panel from Henry DeHar. During the Shell hype, we saw PE funding teams left and right that ended up in many cases not performing investments. Institutional investors shying away from this sector is a case in point. We see now PEs funding teams for ESG clean energy projects when in many cases these teams built their experience in oil and gas rather than having a long track record in clean energy. Any other panelists can pick this up. Can you tell us the approach you are adapting to now avoid, this is a good question, the pitfalls we have seen in oil and gas? And I'll just chime in on this quickly. This is one of the reasons we're having this meeting with our geologists and trying to connect them with the PE world. It's because the technology folks, the geologists were frequently ignored or overlooked when some of these deals were occurring. So, but anyways, Richard found that funny. So anyways, go ahead, anyone that wants to take that question.
I'll just start with, I hope we're learning a lesson. I mean, one, I would say a lot of folks have been involved in power generation and other forms of clean energy for a long time, but I don't know that anybody, I guess at this scale, today has a long history in clean energy, but nonetheless, but we do have experience in cash flow and in the perils of too much debt and not having enough cash flow to operate your business. I think, and so there's lessons learned from that. But I hope we're learning our lesson. I think Greentown Labs and the folks that are helping allocate capital to the viable business we talked today that have some real tailwinds behind them and real technology. Is what we need to be doing. My concern is that as we push money for a great cause of energy transition, reducing carbon footprint, that we're just throwing money at the sector, and we're going to make the same mistakes again. We made the mistake in the tech in the 90s, right? Made the same mistake again with E&P, and I hope we're not doing it again. I think, well, the market this week would say we maybe have done it a little bit, but hopefully that's a lesson I hope we're learning. I think we are. I think maybe limiting the amount of capital to more viable businesses, or at least in teams, which I guess leads to maybe his question, is hopefully where we're headed.
I think I'd jump on there and say that there are some pretty clear lessons that folks that really selected and groomed the private equity teams that were successful, others that weren't. Either way you look at that, the private equity firms learned a number of lessons on how to select teams. I think those lessons should be salient and transferable to this next wave. A good private equity team, I feel, a good team period, I feel, given the right opportunity, can make almost anything work. And so as you sort of look towards the green space or thinking about investment in that space, really I would just start with turning back to the private equity sponsors of the past and saying, what actually did work? What would you look for in the future? And I think we're seeing some of those things occur in the oil and gas space more and more. Obviously, there's retrenchment from the space in the private equity world, but you still observe that the teams that were super successful have done the things that Josh just mentioned, right? They've watched their cash flow, they've watched their debt, they try to be in the right place opportunistically, and they've also tried to make sure that they're thinking long term. That changed with the market, but those exact lessons will be important for this next generation as well.
So I'll just make a couple comments. One, I think the market's learned its lesson, so I'd be very, very, the capital's not there, right? So those leverage models and the boom and bust, when I remember reviewing models where they were investing on $6 gas and $80 oil forever. So that didn't turn out very well. And so capital discipline, but we are in a period, interestingly, and you've seen this in the press everywhere, where we're kind of in a triple dip, right? We have several years of low investment. So we're not investing on a depleting asset base. You've got very, very low inventories. Those have come back some, clearly. And we've got growing energy demand. So the one thing is the demand has not decreased. And I think the time horizon is very important. So we're not suddenly going to not need fossil fuels, whether for power, for transportation, or for materials that we need. There's fertilizer, all sorts of other petrochemical products that aren't going away. They're just going to increase. And so that is a time horizon of 30 to 50 years. So I always say there's three buckets, and where there's money to be made and lessons to be learned, private equity is going to come in. So investment thesis, I think, will form around your incumbent businesses, because there's a time horizon for that to be very profitable in a disciplined way. But it's going to look different. Like the private, a couple of the private equity-backed companies that are just in your traditional oil and gas in the basins operating, they're looking at, hey, you better make sure that you've got specific goals on methane reduction, methane intensity, carbon intensity. You're looking at, hey, can I electrify, whether it's vehicles that are running around in the field, or it's, getting away from diesel generators, all that stuff. And really having an outcome that says, I'm delivering a product that the world wants and demands at a reason, at a price that I can make money. And I'm also, keeping carbon neutral, right? So I think that there is space for that kind of capital, and that's going to get deployed because we're going to need the product. And the second is going to be this new technology, and it's not just, wind and solar. That's definitely going to continue. That's been on a tear for the last 10 years, and I expect that to continue, no doubt. But there'll be some dampening effect on that. I saw somebody put in the chat. It takes power and it takes energy to produce that stuff. Energy costs have gone up, so there's going to be some inflation in those costs. And then the minerals required, it's just not there to meet really the ambitions, whether it's, batteries for EVs, batteries for storage. They're not competing. So you got utilities, you got the OEMs that have made mass commitments on EVs that are coming online. The battery technology is not quite caught up with that, nor has the mineral chain caught up with that. It's wonderful to say you're going to build all these battery factories, but until the miners show up and start increasing, copper, lithium, rare earths, nickel, not just the rare earths, but those base metals by 200x, you're not going to meet these goals. So I step back and, if you're an investor and go, okay, I'm going to be really good on my ESG score, but I'm going to go into incumbent businesses and I'm going to print money at, $65 to $70 a barrel. And I'm going to be very, very disciplined on that. So I do think that there's room for those three buckets and that new technology also. But that's new space. And as someone said, who has that track record that's not, solar and wind? So if you're going into these new technology spaces, whether it's digital innovation or it's, other types of, pump storage type technologies or just, very more base technologies, efficiencies, demand management, demand response, that's all new. So I think it's a level playing field.
Deborah, thank you very much. You mentioned lithium. There's a question in the chat from Josh Turner. Can anybody comment on lithium or other mineral extraction from wells? Are you seeing much money or an interest in this, or is there still very niche and for the Chevrons of the world? Does anyone have a pulse or a response?
Well, lithium is in very specific parts of the world, right? So I don't know if there's any mineral geologists here. So there's a lot of resources in the United States, but getting permitting, a lot of them have been closed. So you're talking about lithium mines in China, Chile, but there's environmental concerns about that. And so this is, and if you look at the key components for battery technology, the majority of that is in China, or that it's controlled by China, and then some rare earths in Africa. So it's a complete pivot in sort of the dynamics of resource allocation. And the mining companies just, it's hard for them to see a pathway to say, because these are all, long-term, long cycle investment production to realization too. So where are the demand signals? Are the demand signals strong enough for them to start really plowing into lithium? But I do think as, geoscientists and you guys are definitely well qualified to kind of go after that growth as well, because there's got to be massive growth. Simon Moore is someone that you all can look at his Twitter and his LinkedIn. I mean, he's just done tremendous research. So has Woodmac and, EY, we've put out research as well.
Super. And then if we have any experts in the audience on lithium mining.
I'll just make a comment, Mark. My whole background is oil and gas, and I think, it's industry is trying to, get ahead of the curve when it comes to, ESG and our emissions and really drive that conversation in DC. But when it comes to batteries and some of this mining discussion, this is being talked internally at the IOCs, right, as a possible, opportunity. But at the same time, we have to be really honest at the end of the day. If you're going to forge ahead and push this ESG, we have to look at how are those minerals being mined. A lot of times it's child labor, right? Or, really it's a human rights issue, right? From an oil and, from those other countries. So, this really where, you really have to have these brutal and honest discussions, not even from an oil and gas standpoint, but the investors, right? That, are looking for that development, right? How do you balance this whole thing out? What are you willing to live with, right? At the end of the day. And I think that's the debate and discussions we have in industry all the time.
Great commentary. So, this question is directed to Paul. What size deals make up the A&D small and mid-cap asset space?
I'm afraid I didn't hear you there, Mark. Try again.
No worries. What size deals make up the A&D small asset space? And then, you can talk about mid-cap and then Marc and Deborah, if you want to chime in on maybe some of the large cap spaces as well.
Yeah, so I'd say anything really from any size deal to about $18 to $20 million is sort of the small cap space as we consider it, and most do. And then the mid-cap space is the $20 to $200 million space, although those lines, end zones sort of get pushed when prices rise, right? So I think you'll hear that Deborah will probably chime in on this, that the larger space will get pushed up significantly as prices start to increase and stabilize, more importantly. But yeah, that's really the space as we see it, though. It's the 0 to 20, say, for the small cap, and then the 20 to 200-ish for mid-cap.
I'll tell you what I found interesting in 2021 is the relative size of the transactions. We saw earlier, in the consolidations of a lot of private equity and consolidations of public companies, relatively large transactions in the, hundreds of millions of dollars, 200 million. In 2021, we saw a lot of transactions that were in the 10, 15, 20 million range. And so it's partly, I think, due because of capital constraints. The transactions, are smaller. The companies are being more conservative. And that was kind of an interesting trend that I saw.
Yeah, that's exactly what I mean. That's about the larger space being sort of in flux. As you see that sort of pricing stability we've observed over the last 8 years, at least, you could clearly point to times where that large cap space has definitely drifted down and mid cap has gone up, et cetera.
Deborah, you wanted to say something, or Josh? No? Okay, fantastic, super. And then I guess I'll address this to Marc. Marc, how important is it for a management team to find an industry or sector specialist?
I think it's important. I've worked actually in a broad range of industries, and those private equity firms that have specialty or niches in certain areas can really add a lot of value to the team. It's smart money. It's going to help, and they're familiar with what you're doing, and they can help you succeed and accelerate your success. And so I think it's what I've seen. It's very important, and it's worth the investment of time to try to figure out who has those kinds of specialties and expertise. That's it.
Super. And then, folks, how do you think, because, again, one of the reasons that we actually created this event a few years ago was I would attend NAPE, for example, and various other industry finance events, Adam, Houston Producers Forum, Houston Energy Finance Group, TIPRO, et cetera, and I would rarely see, I might see, one of our board members, a couple of our board members, et cetera, at some of these events. But how do some of our industry specialists that we have in our group, how can they, connect with private equity or is it through spheres or circles of influence such as yourselves? I guess I'll address that to Marc and then the rest of the panelists.
I think, networking helps, and there's always the opportunity is to meet people that can connect you. I think the private equity guys tend to be not as, at least in the circles that I run, the ones that you mentioned, they're doing their deals. They tend to be kind of private as opposed to what you see at some of the networking events, at least in my experience. And you almost have to know someone to get a response.
Super. Yeah, no, totally agree. And so how do folks?
Maybe Josh ought to try.
Pardon?
Maybe Josh ought to respond to that. What do you think, Josh? I mean, do you, in terms of the, do these networking events a way to reach private equity and potential sources?
I think everything helps, but with the access to data now, as far as not having to go to, say, a NAPE function to find out the latest hidden gem is. Richard is finding it for them and probably reaching out more than anything. As far as creating that deal flow. But I think networking is never going to go away. I think now it makes it easier to network socially through whether it be Zoom or LinkedIn and these things like Marc and HGS have put together. So I think it's easier to connect with people, but I guess it's harder to personally connect and know who's really got some substance behind them and also capital. So substance being capital and knowledge and know-how, experience. I think that may become a little harder. But again, that's people like Richard and similar firms. I think that's not to put this on you, Richard, but I think that's your job is to make these deals happen, right?
Yeah, so I think that it's interesting. We'll see meet some people that will say, yeah, I really want to get private equity funding and get moving. And the question naturally goes to, what's your idea? Well, I've got a great idea to go and drill X, Y, Z. Okay, what's the plan? How are you going to do it? Well, as long as I have capital, I can figure it out. No, you got to go a little further than that. Just get the plan together, get the team together, make it as easy as possible so when you're approaching private equity sources, and it's not a headache. There's just no real space for a one-person effort seeking private equity dollars. That's just the bottom line.
Superb. So what I'm hearing is folks from HGS, make sure you get your plan together and have a team. Is that what we're hearing?
Yep.
Okay, fantastic, superb. So you heard it here from Richard first. So let's make it happen. Okay, Richard, then I'll go to you again. What assets are most likely to sell compared, and which are most likely to be stranded? So,
yeah, when you think about assets that are transacting today, first of all, they're PDP heavy. Unfortunately, the market for acreage-only deals, not referring to prospects, but acreage-only deals are light PDP with a large acreage component, where folks are seeking maximum dollars for the effort they've put into the landman. Those just aren't transacting, or at least not transacting at a level that the groups that hold them are typically willing to part with them. So that obviously, I could say Permian, that's where everybody knows those are occurring. But beyond that, it's really going to be concentration risk has to be balanced. So you don't want to have every bit of asset in one single section. You want to have enough PDP component to get your value up. You want to have enough acreage underneath you to have at least a line of sight to the future, or a plan to get to the future development, or trade even. And beyond that, really thinking about assets that are balanced and not too broad. So where you don't have everything in one single block, you don't have everything spread across the lower 48, where you have 0.0001% non-op interest in 3,000 wells. So there's definitely a Goldilocks zone try to advise groups to grow to or trade to in order to help them meet the market in the best foot forward fashion.
Yeah, Marc, I see it in two things. One, there's two types of assets I would say is companies. I mean, like consolidation still needs to occur. We've seen an uptick in consolidation. Would be from publics as well as the smash growing PE. But there's still, probably too many players in certain basins. Not to call any certain basin out, but so I think there's still consolidation there. That's one type of asset. And then we're seeing a lot of opportunities, onesies and twosies through just investment through the well bore. One board that I'm on, U.S. Energy Development Corp, we deploy $100 million in capital per year and have and through consolidation at the larger scale, we're seeing a lot of opportunities to co-invest on a non-op basis, or even take an operatorship in a single well bore with some of the majors. A ton of opportunity there. And so I think people who are good at what they do will see opportunities they'll find the opportunities to make some money in any basin. And that's even outside folks who are traditionally been in the Permian or Eagle Ford, migrated to Haynesville. There's now seeing some really good opportunities in the Arkoma. I mean, natural gas prices are where they are, where there's some banger wells that are ripe for investment. So good people are finding those deals. Yeah.
And the same question to Marc and Deborah as well.
Well, I think the teams that are being successful, I think the management team is the most critical part. The Rock is a close second, and their ability, their preparedness, and their meeting with the private equity and having the data and supporting data and their responsiveness in responding to the questions of private equity. That's what having to go back and getting back to the private equity a couple of weeks later is just not a good look. And I think it decreases your chances of having success. You've got to ride that momentum, that the love that you get maybe initially, and don't let that subside. And so I see a lot of teams fail because they don't respond quickly enough and don't have the supporting data.
Nice. Deborah, same question to you as well.
The specific question, sorry about that. Somebody was trying to ping me on my phone while you asked that question.
No worries. Yeah, I figured that. What assets are most likely to sell compared to which assets are most likely to be stranded?
Stranded. Boy, I wish I knew, right? Because I'd go buy those assets. Look, I think that for the near term, we're going to need all the assets in the next 2 to 3 years. But to Marc's point, it is really about operating efficiency. I mean, if you're operating wells that are not efficient and are in any way not compliant, and you're going to be in trouble, right? Because sentiment is going to move against you in terms of, are you, clearly flaring is an absolute no-no, right? So it's those types of things. So I think that management teams that can show up with the data to prove that they are a good operator, I mean, there's going to be room for them to just completely ride that asset to the blowdown, right? And I think that there's going to be enough run on the price for teams to do that. And those teams then will be able to take over, poorly operated assets and really continue on that journey. So I think I'm pretty bullish on energy right now.
Nice. Heard it from Deborah.
I'm glad to hear it.
Well, I did want to comment on the, trying to meet with private equity. You do, I think Richard said it, you need to have a really solid team. And if you've got a track record, great. Otherwise, you need to kind of find those teams that, private equity that has an investment thesis where they're looking for sort of semi-greenfield. But you need to network, whether it's with advisors that work with them, because we do get asked, do you know any good management teams? Do you know any good companies? And so I think networking at events like this is really good, and kind of getting into some of the, whether it's the law firms or other advisory firms that are putting on a little seminar. I think you want to get in there and kind of have a pitch, but it can't just be, I got a great idea or I've got a great asset. I got a great team. Here's a little bit of a track record. Here's my runway to EBITDA and scale. And here's my pitch book. And that kind of will get you in the door and have, more conversations and maybe even a little bit of a pre-funding before they make a commitment. And so I think it's got to be very programmatic in order to get in there. But they don't, they're not out, just looking for networking. They've got a lot of people pitching them. So once you got your act together, don't feel afraid to pick up the phone. Yeah, call them.
Super, and I'm going to reiterate that, folks, because again, like I said, the main reason that we actually have this event is because, I have ADD, so I just, I tend to attend all these different events. Obviously, I have my own businesses too, but for the benefit of our members, right, put together a good team. You might find a CFO at Houston Energy Finance Group. You may find, a good CFO at PASH, which is the Petroleum Accountants Society of Houston. Right? It's not just you need to have that team, and then you need to have that plan together. So, and even Deborah, I remember a couple of years ago, I was at the EY Oil and Gas Summit where I met. What's his name, over at the Federal Reserve, and he's been on a few of my events. So Ernst & Young has oil and gas events, and in fact, there are a ton of CFOs in the room. So you kind of have to can't remember how I got invited, but I did. So you kind of have to figure out where these events are. Like I said, Deborah's numbers on the website, right? Hey, Deborah, when's your next oil and gas function coming up? I'm a member of Houston Geological Society. Great, come there and network. Superb. So, and there's a Josh, you have something to add?
No, good. I just want to make sure my lights didn't turn off here.
No worries. Wave your hands in the air.
Yeah.
Mexican wave. All right. So outside of West Texas, New Mexico, and Oklahoma, what are areas that are hot in E&P, and what basins have potential in private equity's eyes? And this is an open question.
Well, I'll start kicking off here. I think that we've seen basins that we've sort of hoped would emerge as shining stars for a number of years, like the Powder River Basin, really start to come into vogue here very recently. That's good to see. There's Josh hit on a very important part, though. There's a lot of consolidation still occurring across the space as a whole. So we're sort of seeing this malaise almost between the majors who have the free cash flow constraints, where they're not allowed to really get out of the free cash flow penalty box until sometime in the future. You've got the private equity world, which has a new mandate to go forward and grow. And so you're seeing some companies do some really impressive things with the assets they hold. And so you're seeing privates and mid-sized companies alike in places like the Powder River Basin really start to spin off some incredible results. You've got some down dip Woodford, excellent gas results from public companies that are traded. You'll continue to see these sorts of reinventions of existing basins that have already proven to be obviously working petroleum systems, but may have not shown the best returns to date, where you're just applying technology that's been ferreted out in other basins now into those areas. Where things will be a little skinnier is places we know of inventory starting to, I wouldn't say dwindle, but it's definitely decreased. The core of the Eagle Ford, obviously, we're not going to spend or see a large resurgence in lower Eagle Ford drilling across the entire play there. But I do think you'll continue to see the Haynesville push the edges of the basin. We've seen some incredible results out of the San Juan Basin, for that matter, and some old channelized plays there. So lots of exciting things to go and tease out, but it's really going to take a strong geology approach to get to that next level of production.
Josh?
No, I think I'd echo what Richard said. I mean, I mentioned Marc home is one. Just there's opportunities everywhere. I mean, not say everywhere, but I mean, there'll be opportunities in each base. I don't think anything else that I could really add that is profound on hidden gems.
Okay, fantastic.
I think the Permian is still the king, and we see some of the fringes of the Permian, or what's been defined as the Permian. There's activity going on there. I have a lot of representatives, not a lot, several teams that are doing more conventional type drilling and approaches, and taking that approach is to increase, having higher returns, and so we'll see how it works out.
Okay, fantastic. Thank you. And then for our next question, I'll go to you as well, Marc. Can you tell us the differentiators in funding versus non-funding? You're on mute.
Oh, like we said, I think it's management teams, their preparedness, the soundness of their proposal, the lack of issues, the track record, and being able to respond quickly and efficiently. That's it.
Excellent. I appreciate that. Deborah.
I guess, if you don't mind, I'm going to tag on there real quick. We're in a unique position because we're on the sell side typically, and we see management teams come through that are looking to screen assets and get in front of folks like Mr. Jones here to sort of request the next steps, right? And it's really interesting how we talk about the team needs to be very buttoned up and well put together from a technical front and a financial front, but it goes beyond that. we've seen places where it appears that things didn't quite work out because teams didn't have the right chemistry. So choosing that team and really forming that team is more important than just finding a good engineer, a good geologist that you've known in the past or have heard of. It really comes down to being a fully integrated unit. And I've observed at least one instance where that's kept a group from getting to the next round. So just food for thought.
No, that's a great point. That's an intangible there. Marc, Josh, and even Deborah, if you can discuss, chemistry and how that affects, good deals and good opportunities.
It's good leadership. Leadership and chemistry are critical. It's very obvious to the private equity and all the people involved whether or not that's there, and even shareholders or even can see it, so I think it is important. I reinforce that.
Superb. Yeah, that doesn't usually come up, but thanks for bringing that up. Deborah, Josh, you want to chime in quickly?
I mean, I don't have much to add, but one of the reasons that you see teams consistently go from one deal to the next deal and they roll over is because that's what they're looking for. They said, okay, this is a proven team. They know how to work together, and that's what they've been able to create that chemistry. So that's why a lot of people, when I see in teams come together, it's like, hey, we worked together for 30 years, and then we kind of went out on our own. And so I think that they are looking for that. So you need to you probably need, it's better to have someone that's going to be on your team that you really connect with versus trying to go out and get the smartest person in the room.
That's a very good takeaway. Josh?
Yeah, so one thing, I mean, so experience helps, certainly chemistry. People have seen success. They've been a part of success, and it may have to be the same people. I mean, at the top, and maybe they're lieutenants that are getting a look. But I think one thing we're seeing is maybe not shying away except from the people who can do it over and over again, like Alan Smith, Porter Trimble, those guys who've been around for 30 years, and seem to make money in any market. They find they found the right deals, and they know how to run a company and make cash. But outside of that select group, I think we're seeing some PE shy away from those longer tenure teams that have, especially they're coming out of the majors, that have only seen it one way, and attracted to more entrepreneurial folks who have some experience. I mean, they're not green, but they're willing to take and invest in, accept technology, use of technology, manage data, and can move quickly. Versus maybe teams that they've good chemistry, been around for a long time, but they've only done it one way. We're seeing that kind of differentiation in the teams we're working with.
I'll mention one other thing. I've been part of teams that came from big companies, and they were using the big company model in their approach to acquiring assets and financing and how they did things, and they were not successful. You really need someone that can operate, have all that knowledge and experience and resources, but you need to be able to operate a lean and mean team. You really don't, the private equity is not going to allow you to have very long anyway, have a huge team that around you. At least my experience has been.
Great. This is some great gems here. And so, Richard, what's the primary role of the geologist in an A&D firm?
Yeah, so often it's sort of the mystery of what a geologist does in an A&D firm, it seems like. So to distill that, it's really twofold. The first thing that a geology team is really there to do is support and demonstrate that the production is supported by the rock quality and properties, right? So is production long-lived? Should we expect something to happen in the near future, in the long term? What's really driving this? And then beyond that, the geologist is there to help demonstrate the potential for upside development or lack thereof. So between those two things, you really find the navigational abilities exist, and that's where we spend most of our time.
Okay, fantastic, superb. And then I'm going to go to my next question. Deborah, can you please address policy and regulatory guidance and impact?
Mark, we can't hear you.
Oh, am I on mute?
No, you're just far away from your mic.
Can you hear me now?
Yes.
Okay, great. Deborah, can you please address policy and regulatory guidance and impact, i.e. recent infrastructure bill and the recent executive order announcement on offshore wind and the up-and-coming SEC guidance? And then Josh, if you can chime in on that also.
I'm going to lean on Josh to comment more, but yes, it's all coming. So the recent infrastructure bill, so, the key there is take a look at it. There's some really good summaries online, but it was the spend part of it, and there was a significant portion on just traditional roads and bridges. But as I said, on the sort of the new energy technologies, climate resiliency, broadband. But even without that bill, there's quite a few loan and grant programs. If you go to the DOE website, that money is just sitting there. Now the money has been appropriated. They need to spend that. And so if you have some good ideas, definitely, unlike private equity, they actually want to talk to you very early stage to understand what your idea is, whether you're eligible for a grant through the fossil fuel division or loan guarantees, that sort of thing. So that's out there, definitely worth looking at. And then the Build Back Better, in some form, it's hard to know how much of that's going to come. There'll be some tax incentives around new energy technologies, whether it's CCS, hydrogen. So that sort of the incentive piece is coming, as well as, additional taxes on sort of the general business operations, et cetera. The SEC guidance, it's been expected. It's going to be around, if you've looked at emissions and ESG reporting around TCFD, which is the framework that the Europeans have really centered around. We expect that guidance to come out towards the end of the month. Josh, I don't know what you're hearing, but Gensler's made a lot of speeches about this, so it's clear he's going to be looking for very specific climate disclosures, but he's also going to be focused on sort of greenwashing and other aspects of ESG reporting.
Right. Yeah, I think I'll admit more governance, more regulations drives my business. I mean, just from accounting, reporting, SEC. So while nobody likes additional regulations, sometimes that kind of does drive our business. So I think, in some sense, I'm looking forward to that. But what I'm looking forward to is hopefully just some additional clarity. As Deborah mentioned, we've been waiting for maybe before the end of the year. Now it's hopefully by the end of the month. Hopefully the end of this quarter, whatever it may be. It needs to happen soon. To avoid it, as Deborah mentioned, there's a lot of money is in the system. It's ready to be spent. And hopefully, I think with additional guidance from the SEC around what is meaningful to them and meaningful to the investor base of how to report on your ESG advancements, the reduction of your carbon footprint. Give us some clarity so firms aren't just wasting money trying to guess on what that may be. Some additional clarity would help. What I would like to see, but I don't think will have happen, is some additional financial statement disclosure on the underlying economics behind some of these new initiatives. So, for example, just to use solar, for example, or wind. I mean, okay, is it economic? Well, certainly there's talks of economics, but how much of this business is really driven by government subsidies through tax credits? I'm not saying that's bad. I'm not saying it's good. It's helpful in driving investment, and that is good. But ultimately, what's the sustainability? At the end of the day, it's all about sustainability. What's the sustainability of these business models for public registrants, and even from that, people who are accessing the private placement markets, all these underlying businesses, and what's their cost structure, what's driving the revenue and the components there. That's what I really like to see. I don't know that we're actually going to get there. I think it's going to be more about, hey, tell me, how you're reducing your carbon footprint, period, and all things related to that. But something will be good.
Fantastic. So rig counts are well above where they were last year, but less than half of their pre-pandemic peak, which was less than half of the peak before the 2014-15 downturn. Folks, what do we think it will take to get more capital into the oil field?
Well, I'll just say return cash to investors.
Yep.
Period. Stop. It starts there. I think also, I don't know what the day of the year that we get to net zero, if maybe ever, but certainly there's room for improvement with the E, S, and the G, and people have to do that and have to show that they're improving that. So those two things will bring cash flow into the sector. But as far as rig count, my personal view, and folks on the panel and all of you are more responsible, more knowledgeable than I am about what those numbers are, can be, should be. But the time of history, that's over. I mean, going from a conventional, putting, sticks on the map, drilling, wells conventionally to then, rigs on multi-wells on pads horizontally, et cetera. And to now just, limited inventory. I don't know what the number was at the high, but we need to reset the expectations on the number of rigs in overall and in each basin.
Yeah, actually, I've got some materials I was going to share, but I might try to jump to a slide that addresses that, if that's okay, Mark.
Yeah, no, please do. Let's go ahead and do that.